1.3 billion pounds. That is not a typo. That is not a rumor. That is money that HMRC collected from UK pensioners that it should never have taken in the first place. 1,300,000,000 pounds, sitting with the government, belonging to ordinary retirees who worked their entire lives, saved where they could, and are now living on fixed incomes, while HMRC quietly holds money that is rightfully theirs. And here is the part that will genuinely surprise you. Most of the people who overpaid have absolutely no idea it happened, not because they did anything wrong, not because they failed to fill in a form, but because the system that is supposed to get your tax right, the system that is supposed to automatically adjust when your circumstances change, quietly got it wrong. And it kept getting it wrong, month after month, sometimes year after year. If you are retired or approaching retirement or drawing any kind of pension income, what I am about to share with you today could be worth hundreds of pounds, in some cases, thousands. I am going to walk you through exactly how HMRC overtaxes pensioners, the most common mistakes that cause it, the reasons most people never notice, and then, most importantly, the precise steps you can take today to check whether you are owed money and how to get it back. Stay with me through to the end, because there is a section called "So Here is the Full Picture" that pulls every single piece of this together. And there is a deadline I will share with you later in this video that a surprising number of pensioners miss entirely, and it costs them everything they were owed. Let us start with the story behind that number. The 1.3 billion pounds story. Every year, HMRC processes tens of millions of tax transactions. For most working-age people on a standard salary, the PAYE system, pay as you earn, tends to handle things reasonably well. Your employer deducts tax before you receive your wages. One employer, one source of income, relatively straightforward. But retirement breaks that model. When someone retires, their income picture changes completely. You may have a workplace pension from a former employer. You may have a private pension you contributed to independently. And on top of that, at some point, the state pension kicks in. 3 income streams, sometimes more, all arriving at different times, often from different sources, none of which automatically talk to each other, and that is where the system starts to break down. HMRC's own data, analyzed and reported on over recent years, has confirmed that pensioners across the UK have collectively been overtaxed by a figure now estimated at around 1.3 billion pounds. This is not theoretical. These are real overpayments, many of which have been refunded, but only to the pensioners who knew to ask. The rest of that money is still being held, waiting. For people who do not know they are owed it, here is what most people do not realize. HMRC does not automatically refund overpayments in many situations. In some cases, they eventually reconcile accounts at the end of a tax year. But the process is not always automatic, not always accurate, and, critically, not always communicated clearly to the person who has been overtaxed, which means the burden falls on you to check. The real surprise is not the amount. The real surprise is how easily these overpayments happen, and how normal and reasonable everything looks on paper while it is occurring. How pensioners get overtaxed. To understand why so many pensioners end up overtaxed, you need to understand how HMRC handles pension income when it first starts being paid. When a pension provider begins making payments to you, they need to apply a tax code. That tax code tells them how much of your income is tax-free and how much to deduct at what rate. The problem is this. When a pension starts for the first time, particularly if it is a lump sum, a flexible drawdown payment, or any kind of non-regular first payment, HMRC often does not have a tax code ready for that specific income source. And in that case, the pension provider is legally required to apply what is called an emergency tax code. Emergency tax. The phrase sounds alarming because it is alarming. An emergency tax code assumes, often incorrectly, that the payment you are receiving is one installment in a regular series of 12 monthly payments per year, and that you have no other allowances to apply against it. The result is a calculation that treats a single pension withdrawal as though it is your entire annual income, annualized, and taxes you accordingly. Take this example. Margaret is 67. She has a pension pot worth £40,000, and she decides to draw £10,000 as a flexible payment. Under normal circumstances, a portion of that would be tax-free, and the rest taxed at the basic rate. But because it is her first withdrawal and HMRC has not yet issued the correct code, her pension provider applies emergency tax. HMRC effectively treats that £10,000 as if she is earning £120,000 per year. Her tax bill on a single withdrawal ends up being several £1,000s more than it should be. This is happening to pensioners across the country every single week. And the frustrating part is that it is not illegal. It is the system working exactly as it was designed to. The design, however, was not built with flexible pension access in mind. It was built for a world where people worked until 65, took a defined benefit pension, and received a fixed monthly payment for the rest of their lives. That world no longer exists for most retirees. But there is another mistake that accounts for an even larger percentage of the overpayments, and this one catches people completely off guard. The most common HMRC errors. The single most widespread cause of pensioner overtaxation is the wrong tax code being applied over an extended period of time. Your tax code is a number and letter combination that tells your pension provider or employer how to calculate your tax deductions. The standard code for most people in England, Wales, and Northern Ireland is currently £1,257. That reflects the personal allowance, the amount of income you can receive each year before paying any tax, which currently stands at £12,570. But here is what goes wrong. When a pensioner has multiple income sources, a state pension, a private pension, and perhaps a small occupational pension, HMRC has to split the personal allowance across those sources. If this is not done correctly, you can end up with too little personal allowance applied to one source of income, which means that source is taxed as though you are earning more than you actually are. Worse still, some pensioners end up on a tax code with no personal allowance at all, is what is called a BR code, which taxes every pound at the basic rate of 20% regardless of your total income, or an OT code, which applies no allowances whatsoever and can result in higher rate tax being deducted. Consider this scenario. David retired 2 years ago. He receives the full new state pension, currently £11,502.40 per year for the 2024 to 2025 tax year. He also has a small private pension of £4,000 per year. His total income is £15,502.40. He should be paying tax on roughly £2,932 of that, the amount above his personal allowance. His tax bill should be modest. But if his private pension is coded incorrectly as BR, taxing every pound at 20%, he will be paying tax on the full £4,000 without any allowance. That is an overpayment of roughly £614 per year. Not enormous, but over 3 years that is nearly £1,800 that belongs to him and is sitting unclaimed. And because it is deducted before he ever receives the money, David may simply never have noticed. This is where thousands of retirees get caught out. The payments look normal. The amounts going into your bank account feel like what you expected. Nobody rings to tell you that your tax code is wrong. The letters HMRC sends are not always easy to understand, and most people, quite understandably, trust that the system is handling things correctly. Most people assume HMRC automatically fixes these errors. It does not, at least not always, and not always promptly. But there is another hidden reason why many pensioners miss refunds, and it is even more common than a wrong tax code. Why most people never notice. There are 3 main reasons pensioners fail to notice they have been overtaxed. The first is that pension payments arrive net of tax. You receive what you receive. Unless you know what you should be getting before tax, and you understand your tax code, you have no reference point for what the correct net amount looks like. The second is the state pension itself. Many people are surprised to discover that the state pension is taxable income. HMRC counts it toward your total income for the year. But here is the important detail. The government does not deduct tax from your state pension payment directly. It arrives in full. Instead, HMRC typically adjusts the tax code on your other pension, your private or occupational pension, to collect the tax owed on your state pension through that source instead. If that adjustment is applied incorrectly, or not at all, or at the wrong rate, the knock-on effects can be significant. The third reason is the complexity of end-of-year reconciliation. HMRC runs a process called the P800 reconciliation, where it reviews what tax you paid during the year versus what you should have paid. If you overpaid, HMRC is supposed to send you a P800 notice telling you that a refund is due, but not everyone receives one. Some are sent to old addresses, some are missed, and some overpayments are simply not picked up in the reconciliation at all. Very few pensioners know that if you do not receive a P800, you can still proactively check and claim. The missed opportunity is that the personal allowance, £12,570, goes completely unused for some pensioners who do not know they are entitled to it. If your pension provider coded you incorrectly in your first year and that was never corrected, you may have been paying too much tax every month for years. The next part explains exactly how to check whether any of this applies to you. How to check if you are owed money. The first thing to do is locate your tax code. You can find it on any payslip or pension payment letter from your provider. You can also find it on any letter HMRC has sent you in recent months, and you can check it directly through your personal tax account on the gov.uk website, HMRC's own online portal where you can view your tax codes, your income records, and any refunds due to you. Setting up a personal tax account is free and takes around 10 to 15 minutes if you have your national insurance number and some form of photographic ID available. Once you are in, you can see your current tax codes across all of your income sources. Then check this. If you are receiving only the state pension and one private pension, your tax code on the private pension should reflect your full personal allowance minus the state pension income. So if the state pension is £11,502.40 this year, your private pension tax code should reflect the remaining £1,067.60 of your personal allowance, meaning the first £1,067.60 from your private pension is also tax-free. If your code shows 0 allowances and a BR or OT code, and you believe you are entitled to the personal allowance, that is a flag that needs investigating. Also check whether you received a P60 at the end of the last tax year. The P60 is a document from your pension provider showing your total income and the total tax deducted. Add up all of your income sources across the year. Then check whether the combined total exceeded £12,570. If it did not, if your total income was below the personal allowance, you should not have paid any income tax at all. If tax was deducted, that is a refund waiting to be claimed. If your total income did exceed £12,570, check how much tax was actually deducted across all sources combined. Then calculate what it should have been based on the basic rate of 20% applied only to income above £12,570. There are free HMRC calculators available on gov.uk that can help you do this. Before moving on, there is something important you need to check specifically if you made a flexible pension withdrawal in the last 4 years. If you drew down a lump sum or a first income payment from a pension pot and you were taxed using an emergency code, you almost certainly overpaid, and you may not have been automatically refunded. The next step could determine whether you receive a refund of hundreds or potentially thousands of pounds. How to reclaim your money. There are 3 routes to reclaiming overpaid tax, and the right one depends on your situation. The first route is through your personal tax account. If HMRC has identified an overpayment through its own reconciliation process and issued you a P800, you may be able to claim your refund directly online. The process is straightforward. You log into your account, confirm your bank details, and request the repayment. Many refunds are processed within 5 working days. The second route is relevant if you made a flexible pension withdrawal and were taxed on an emergency code. HMRC has specific forms for this situation. If you took a one-off taxable payment, the form is P50Z. If you emptied a pension pot entirely, the form is P53Z. If you are still in employment or receiving other taxable income, the form is P55. These forms can be completed and submitted online or by post directly to HMRC. Once received, HMRC is obliged to process them within 30 days. The third route is by contacting HMRC directly on the income tax helpline, 03002003300. This is the route for more complex situations. For example, if you believe your tax code has been wrong for multiple years, if you have multiple pension sources that have never been properly coordinated, or if you have not received correspondence you expected from HMRC, when you call, have your national insurance number ready, along with details of your income sources and any pension payment letters you can reference. Ask them to review your tax code across all income sources and confirm whether your personal allowance is being correctly applied. If they confirm an overpayment, ask them to confirm the amount in writing and to initiate the refund. Keep a record of the date of the call, the name of the advisor if given, and any reference numbers provided. Finding the refund is only half the process. The other half is knowing how far back you can claim, and the window is more limited than most people expect. Refund deadlines and time limits. This is where many pensioners lose money they were rightfully owed, simply because they did not act in time. HMRC allows you to claim a refund of overpaid income tax going back 4 tax years. So right now, in the 2024 to 2025 tax year, you can claim back to 2020 to 2021. Each tax year runs from the 6th of April to the 5th of April the following year. But here's the critical point. Once a tax year drops off that 4-year window, the claim is gone. You cannot go back 5 years. You cannot make an exception. The deadline is absolute. If you overpaid in the 2020 to 2021 tax year, your window to reclaim closes on the 5th of April, 2025. After that date, that money is simply no longer claimable. It stays with HMRC. What happens next explains why many refunds go unclaimed. People intend to look into it. They mean to call HMRC. They think about writing down that number or setting up the online account, and life gets in the way. A month becomes a year, and the claim expires quietly. The people who reclaim money are not necessarily more entitled to it. They are simply the ones who acted. For flexible pension withdrawals where an emergency tax code was applied, HMRC expects you to submit the appropriate reclaim form within the same tax year if possible, or at the latest within the 4-year window. The longer you wait, the more tax years may fall outside the window entirely. There is one more rule that surprises people. If HMRC owes you a refund and you do not claim it, and it has not been automatically repaid to you, that refund does not earn interest on your behalf indefinitely. Certain time-limited rules apply. In short, the system is not designed to reward delay. The system is designed to reward the people who check. Now let us put everything together. So here is the full picture. £1.3 billion. That is how much HMRC has overtaxed UK pensioners. Not through deliberate wrongdoing, not through fraud, but through a system that was not built for the modern reality of retirement, multiple income sources, flexible pension access, and a reconciliation process that does not always catch its own mistakes. Here's how it happens. When a pension starts paying for the first time, especially a flexible drawdown or lump sum, the pension provider must apply an emergency tax code in the absence of an HMRC instruction. That emergency code can tax you as though your one-off payment is a regular salary being earned 12 times a year. The result is a tax deduction that can be far higher than it should be. Here is who is most at risk. Anyone who drew down a pension pot for the first time in the last 4 years. Anyone whose tax code is BR or OT and who believes they are entitled to their personal allowance. Anyone receiving both a state pension and a private pension where the allowance has not been split correctly. Anyone who changed their pension arrangements, stopped, started, or switched income sources without following up to confirm HMRC updated their records. Here is how to check. Log into your personal tax account on gov.uk. Review your tax codes across all income sources. Check your P60 documents from the last 4 years. Compare the tax you actually paid against what you should have paid based on your total income and the personal allowance for each year. Here is how to reclaim. Use Form P50Z for a one-off taxable pension payment. Use Form P53Z if you emptied a pension pot. Use Form P55 if you made a flexible withdrawal and still have other income. Or contact HMRC directly on 03002 003300 and ask them to review your account. Here is what the deadlines are. You have 4 tax years to claim. Today, that window reaches back to 2020 to 2021. Every year that passes, one more year drops off. The clock is not paused while you think about it. And here's the thing I want to leave you with. This is not money that HMRC is generously offering you. This is your money, money you already paid, money that was deducted from pension income that you earned over a lifetime of work. The government holds it, but it belongs to you. The risk of checking is zero. It takes minutes to log into your personal tax account. A phone call to HMRC costs nothing. The forms are free. The risk of not checking is real. You may leave money on the table. Money with a deadline, money that disappears permanently once the claim window closes. One simple check today could recover money that has been sitting with HMRC for years. I would encourage you to do that check this week. Not next month. Not when you get around to it. This week. Because we have just covered exactly what to look for, exactly where to look, and exactly what to do when you find it. If this video helped you, Or if you think it might help someone else, please share it. A lot of pensioners do not know this information exists. Sharing this with a parent, a sibling, a friend, or a neighbor could put real money back in someone's hands. And if you want more straightforward, no-nonsense guidance on UK retirement, pensions, and money, subscribe to this channel. New videos go out regularly, and everyone is designed to give you information you can actually use. Do not leave the money with HMRC. It is yours. Go and get it back.